Welcome to Just Think About It with Nadine and Ben. Before we start our conversation, we have two key requests. First, if you're enjoying our podcast, please subscribe via Apple, Spotify, YouTube, or your platform of choice. And then second, we appreciate any kind notes as we get started and letting our friends know where to find us. Today, we're so excited to chat with Mr. Retail himself, Jeff Macke. If you're interested in learning more about the current state of affairs in retail brands, the U.S. consumer, from the most entertaining man in finance, you've come to the right place. Jeff is one of our partners at Wall Street Beats. But long before that, he started his career at Macy's. He's consulted at companies including The Gap, Nike, Sears, Kmart, Jeff founded Macke. It wasn't due to him, though. Jeff founded Macke Asset Management after getting his MBA from Stanford in the 1990s, and he spent 8 years running a hedge fund. He sat on the board of a small cap retailer and several private companies. He's been writing about investing online since the mid-90s, starting at The Motley Fool when he was still part of AOL. He wrote for TheStreet.com, was a founding cast member of CNBC's Fast Money, we have that in connection here, and anchored Breakout on Yahoo Finance. He co-authored Clash of the Financial Pundits with Josh Brown. But for him, it always comes back to retail and the consumer. He's been analyzing retailers since he was just a young kid. Jeff's father was the CEO of Target for over a decade, so we're going to get into that. And you could say U.S. retail runs through his blood. He's been widely quoted in major news publications, including Bloomberg News, the Financial Times, Wall Street Journal, New York Times, Reuters, and many others. And he is a frequent contributor to financial media. Welcome, Jeff.
Thank you. What a nice introduction. It makes me feel a little old, but yeah, it's been a journey, man. This stuff starts to add up, right?
Totally. You know, before we get started into more detailed questions, Ben and I obviously know you well from our time as partners on Wall Street Beats, but maybe you could start off giving our listeners just a brief perspective of your background and career as a retail analyst, fund manager, financial media expert, and how all those different roles shape the way you approach picking stocks in your investment process.
You know, my process kind of starts from the consumer backwards. And I think that you know, you mentioned my father, and you don't necessarily learn everything at the knee of your father. You know, we weren't a family of cobblers or anything. We didn't teach you to make shoes. But we would go to Targets all the time. I mean, he started there. So he kind of worked his way up the ranks. And you know, so right from the time I was very young, he was running Target when Target was not that big a deal. And really just a chain that was founded on the idea of simply kind of rich people like bargains as well. And so they were founded literally the same year as Kmart, Walmart, and Target were all 1962 companies. Target was kind of carving out its niche, fighting for a little oxygen at the Dayton Hudson Corporation. They won. There are no more department stores. But, you know, it's the idea was simply we would go from store to store, and his focus would relentlessly, really, which is what a lot of those CEOs have in common. My dad, no different, but just bringing that huge intensity from the customer focus side. Nothing made him more furious than a dirty store. A dirty store says F you to the customer. My dad did not abbreviate it with the F, and he started saying that. Literally, it's the first thing I can remember him saying from just a child. You know what, a dirty store, what are you telling me? I'm too much of a dumbass to shop here? You don't care enough to clean up your place? Do you host parties with their laundry on the floor? I mean, he would just rail on these guys. And it was just that insistence and that idea that every Target should look the same. They should all line up. The end cap should be perfect. And customers just, it bespeaks a certain amount of respect. And that's a concept that is timeless. And it's really kind of how I view it. And it comes down to just, are you delivering what the customer expects? And then just a tiny bit more. And when a Target store is working to this day, it's not the chain it used to be. I don't even own shares at this point. But when it's working, the magic is that you find a little something extra. Yeah. And, you know, it's the idea like the TJ Maxx treasure hunt, right? Well, I can't believe this was marked down. At Target, it's like, this is a pretty nice shirt. You know, what a cute little dress. What a nice kid's outfit. It costs $12. I could go to a fancy store and pay $50 for something that's no nicer than this. And that's how you get people to buy a little more. They come for the basics and they stay for the good stuff. I've taken that kind of everywhere I go. And so that's the way I think about business. That's the way I think about just about everything I do is who's our end customer with this? And are we delivering what they're looking for? Hopefully we can do it with the pod. But again, I don't know any other way to think of things. As luck would have it, you know, the consumer is a pretty big part of GDP. So you can kind of do most businesses that way. You got to get really deep in the tech weeds before you run out of an end customer. But ultimately, any business is going to come down to, are you giving the customer what they promise at a fair price? And if you do that over and over again, it's going to work. And some of those retailers, that we talked about, RIP Sears, RIP Kmart,
Yeah.
I learned a little something watching them fail. But, it's when a company loses its way, they just, as Sears did under Eddie Lampert for a decade and a half, they're managing expenses. And
Right.
so if you're not going to upgrade your light fixtures because that, you can't do a cost benefit analysis on whether or not your product sells better if it's lit, you're in a lot of trouble because they're not starting at the basics. They're going to cut corners on a lot of different things. And so I think, as we talk, that'll be my attitude over and over again. It's less that a store has to be fancy or high end or anything. It has to deliver what they promise. And that's really my view on all these stocks. And as we look at them, whether you're shopping for stocks as well, a lot of these companies, when a retailer gets really expensive, that's usually closer to the end of the line than the beginning because people expect too much. And it's really hard to exceed insanely lofty expectations. Fortunately, at least up until about a week ago, nobody expected anything from any consumer stock. And now, we're coming off of the best day since November of last year. But, this is going to be a choppy recovery. So it's whatever we talk about now, these stocks are going to pull back a little bit because it's a slow go to fix them. And just with the way the human brain works, and this is kind of why the consumer stocks have been so weak this year. The worst case scenario always pops immediately to mind. And when you get to kind of this deep recession type of thinking, it's really hard to get anyone to want to jump on top of retail stock and say, oh, I'm willing to write it down 50% because eventually the economy will be fine.
And that's what I love. I know Ben's going to jump into the question, but I think that's the point, though, to talk to you is that obviously your vast experience investing and knowing this space, but you want to be doing your homework and picking out those names ahead of time so that when you do get that dislocation, you're not starting your work, you're ready to roll. So.
Yeah. Right. And they're not usually that surprising. I mean, it's the numbers we're seeing, the data we're seeing is not a shock. It's the reaction that we're watching.
Right.
Yeah. And so, that's the name of the pod is just think about it. And it's, to just elaborate on this a little more, the consumer right now reminds me a little bit of energy in 2020 or tech in 2022. And when Nvidia was I bought Nvidia $112. I didn't hold it long enough though. But do we what are the premises underlying this negative consumer view? Is it the labor, the margins, the comps? Let's just talk about that a little bit and in where you could see it. It doesn't, as I guess we saw so far, it doesn't take a lot for it just be less bad, and now we're starting to see a little bit of pops in these things. Maybe talk to that a little bit, please.
A few different things are going on a specific stock level. You still have a reset going on from COVID. A lot of the names that we're going to talk about, they really are trying to just normalize. What's normal look like? I don't know if we're even going to get into it. What a Callaway Golf. No one's going to Top Golf anymore. Is that a forever thing? Their comps are down 8%. Is that just a fad that people kind of went to when we all were distanced a little bit, but just not quite fully distanced during COVID? Or is that going to be a business that stabilizes? That's the question facing a ton of these retailers right now is okay, what's our business look like in a more normal consumer environment? You have that. You have various recession scenarios, and Ben, both of you actually, you spend much more time on macro than I do, but you don't have to work real hard to come up with ways that this can go pear-shaped super fast on a consumer level. We've got much more debt than we used to. There's signs that the credit market's cracking. There's all kinds of reasons to think we had a recession. You layer on top of that the ever-present global uncertainty. Sometimes it matters more than others. But a month and a half ago, we had sort of almost a presumptive president. It looked like Trump was going to walk with it. That fell apart pretty fast. And now we have uncertainty and really kind of a political situation where no matter which candidate you pick, you got one that's promising to raise the minimum wage to just unprecedented heights and everybody gets to be rich somehow. But you guys talk to business people as well. I have friends who run McDonald's. It's a real problem if you're paying everyone in the store $20 an hour to serve a Big Mac. Something's got to give. It's a super huge problem. Well, that's bad for the consumer. Tariffs, holy cow, I still have nightmares. I have PTSD from 2018 when Trump decided he was tariff man. and the price on everything was going to go higher. That's obviously bad for anything consumer discretionary or not. It's bad for staples. So either of those crush your margins. Those are two fairly compelling uncertainty situations. And as the promises get more extreme, as the heat of the rhetoric picks up, you have just kind of, it's tougher to buy the stocks. And you layer on top of that with in any time there's countrywide uncertainty, people just shop less. Yeah. You know, Amazon as much as said so. They said, listen, it's when things got heated, when the country was storming in July, we saw an immediate impact on our business. It slowed down markedly. Amazon has no reason to even say that. They have 9,000 different businesses, the least profitable, which is retail. So I take them at their word when they talk to me about how customers are behaving. You add those three together, you don't even need to get to China. You don't even need to get to, you know, which is also its own unbelievable headache. You know, it's can we make China turn? Well, you know, that has a lot of moving parts as well. Are they going to let us? You know, how much profit are they going to let these companies extract? You add that all up, and you have a situation where these consumer stocks are unviable. Ben, you were talking about on the show yesterday on Wall Street Beats. These stocks tend to bottom before the consumer happens. But they're going to be the canary in the coal mine, and the canary dies real fast when you start to come up with compelling recession scenarios, because anything discretionary just gets chucked for pretty good reasons. The earnings are going lower. Now, that typically is when you want to start looking at the stocks. And so these are not companies that you want to buy when everybody's feeling real good. They're companies that you want to buy when people call you crazy for even looking at them. And that's we're about 2 weeks past where we were before. You know, it's and despite some of the gains, you know, nothing turns fast. Starbucks, to name one that, you know, was up 30% this week. There's nobody that's worth 30% for Starbucks. That's a $25 billion move. You know, it's and people are complaining. The guy was paid $110 million. It's like he seems like a bargain to me.
They're going to rearrange the pastries in the case.
Yeah. I mean, it's, you know, pastries. If anyone goes to Starbucks for the food, Brian Niccol was worth absolutely every single penny, and they've diversified. Hard Schultz has been chasing food for ages, but you know that's going to take a while. That's not going to be tomorrow's business. People aren't going to be saying, "Oh, I had the most delicious croissant with my venti coffee, which was delivered with no problems at all, and I could totally pay for it with the app." None of that stuff's going to happen at Starbucks. It could. It's a fantastic brand. They're not going anywhere, but it's going to take a while for the operations to catch up with the hype on this. Right. But man, these reactions to it tell me that you know, smart people, and you know, you've got people that are still short. I don't know what your catalyst is on the short side. When you look at Home Depot and they come out and say, you know what, we're going to guide comps to -3 to 4%. And then you do the math, and it's, well, the first half was like -1 to 2%. And so you're in effect guiding like -4 or 5, like 6% comp. What, like, geez, this is the worst Christmas ever. No one's building a house for Christmas. That's for absolute certain. And the stock doesn't go lower. Right. And so at that point, they're sold out. At that point, if you're short, I don't know what kind of apocalypse you're looking for, but it's the kind that if Home Depot misses the expectations they've just set, we probably have bigger problems than our Home Depot shares. We've got let's build bomb shelter type of problems, which ironically would be kind of good for Home Depot.
and so when we think about what we just talked about, which the macro's bad, it might get worse. It's known. These are known knowns. And so then we think about some of these companies, like Starbucks isn't broken. It might be stagnating from a growth perspective, but I actually went there twice today for a full, and they don't do the green sticks anymore. So they're already on their cost cutting journey. But like, what is it? Like, you know, you come from that background of thinking about the company and the clean stores. If you're at this point where you're Home Depot or Starbucks or one of these kind of companies that's not going anywhere, but maybe from a stock perspective, it's harder to get people excited. What is the ways you can do it? You can do capital structure. You can change the store. I mean, what do you think about that? New management?
I think when you walk into a Starbucks for the last few years, you could see it's not broken. You could tell by the crowds. There are plenty of people there, plenty of people buying coffee. But they were missing the low-hanging fruit. It always returns to food for Starbucks for some reason. But, you know, it's they were just doing things that seemed so easy to fix. The app, for instance. Now, they collect money in advance. They collect interest. It's a great deal, and it should work for everybody. It should be a faster order. One of the things that got the last CEO fired was when he came on the call in the first quarter and said, you know, by our internal metrics, this app is working great, but we're not completing 15 to 20% of the orders made on the app because the coffee doesn't get made, it doesn't show up, it's almost impossible to pay. I was in Starbucks a week and a half ago in Washington, D.C., and they would not take the money I had on hand for in exchange for a coffee, which seems like the idea of Starbucks. Here's I'm going to give you money, you provide a gooder service, because they couldn't break the bill that I was offering. And of course, it was $1,000 bill, which I like to use because then sometimes they just give you free. I'm kidding.
Maybe
it was 100. But
you go in there with something they can't use. But did you still get your coffee or no?
That's the way I pay off my golf bets. It's like, you got change for 1,000?
Or the Italian lira. Here's some lira for you.
Exactly. I tried to pay in Bitcoin and they wouldn't do it. Now it's like I tried to hand them 100 and they looked at me like I thought I was fancy. Now it's like a $15 coffee. So I'm not the one who caused inflation. Come on, you can't make change. Someone ended up buying my coffee, which turned it into a nice experience, but I literally couldn't work the app. I'm pretty good at working the app. I'm pretty good at consuming things. I'm going to the store all the time. But if they're walking orders to that degree, if both in terms of what they report and also in terms of your experience as a customer, if you can walk in at a slow part of the day and you actually can't buy just a coffee, there's a real problem going on there. And so they're going to slowly lose customers. Now, that doesn't make them Sears. That doesn't make them Kmart and doomed. It just means that they're never going to beat earnings. That they were really kind of going the wrong way with their initiatives and with a lot of the things they were trying to pull off. And so they can be less dumb than they were before. And that goes a long way. Nickel's going to come in and he's going to simplify the operations. They have way too many different things going on to try to fix the flow of a Starbucks. It obviously is a little dated on the back end. They obviously are offering way too many type of products, between the glow sticks and grenadine friendly, just all these kind of crazy concoctions they're offering. They can simplify that and make it a much better business, and that's going to go to the bottom line pretty fast. And so, it was really more directional, and that kind of speaks the narrative, but it's actually going to be an economic fact for them sooner than you think. They were just trying to redo all the stores all at once, and it just kind of paralyzed them. That's going to be kind of a slow and steady, gets it done, focus on 2 or 3 things. One of the things my dad would say, he was obsessed with cleanliness, and he would kind of explain it as, you can only stand for 1 or 2 things as a CEO.
Right.
You can't have 55 initiatives. You got to have something where, holy cow, we were terrified that Ken Macke was going to show up and my store would be messy. These guys are going to be terrified if Brian Nichols shows up and there's a problem with the app. There's 20 people in line at the store and none of them can pay. That's going to be the worst nightmare of any barista at a Starbucks on earth. That's going to be the worst possible thing that can happen. And that goes a long way. It's so these leaders are both kind of overstated in terms of the impact they can have. But if you're Starbucks and you've spent the last 5-6 years kind of in the wasteland of union problems, your store structure is wrong and everybody wants sort of mocha, frappo, boba things, and you're just trying to sell coffee, they've been in the wilderness for a while. And so, you've run out of a short thesis on that and everybody wants to get long all at once. The turnaround is going to happen fast in terms of the narrative side of things. And you and I always talk about, Ben, we can run spreadsheets all day, but if your story stinks, then people are going to kind of ignore the model. It's your earnings model is fine. You're 5 times forward earnings, but I think your forward earnings are crap. And so no one's going to buy that story. I would much rather buy one where I don't know what Starbucks earnings are going to be next year. Hopefully they'll be a little lower because they're going to take charges because they're going to clear the deck. And that becomes a best case scenario. It becomes kind of the single stock version of a Goldilocks economy, where bad news becomes good because it means they're actually kind of tearing it down and doing some things they should have done a long time ago, but they didn't have the sort of fortitude to take a tough quarter or 2.
So I want to dive back and reverse time a little bit. Earlier this year, you had written about and discussed on Wall Street Beats your negative thesis on Nike, and clap there.
Thank you.
Not only for getting Nike right, but how the challenges would benefit other players. So you really saw the landscape as a whole. And I want to share with those folks who might be new to what you were saying at the time, your thesis. It obviously played out brilliantly, but if you could walk through not just what your call was, but how did you get there? What were you looking at to make that call and to figure out who would be benefiting, call it from their challenges and lack of insight into where they sit in the ecosystem and what everyone else is doing, which seems really odd for such a massive, previously well-run company. But that would be really helpful for people.
And such a legitimately iconic company, right? I mean, it's not like they're bad and they didn't all wake up dumb. They just got kind of trapped in a bunch of the wrong directions. They got involved in a bunch of social
you were part of
causes.
Phil Knight's legacy. He'd always come back and he'd be like the hallmark of branding, right? That's what you were taught.
He was the man. Yeah, Phil Knight, actually, it was a business school case study that he wrote for marketing, and the GSP that became freaking Nike. I mean, it was an unbelievably sort of simple, smart business where we're going to build better than you expect shoes. Pretty, we can churn them out relatively inexpensively. We're going to market them a bit, and it was legendary. And the man still is a legend. And I kind of felt bad about ripping the company as hard as I did. But they just were kind of lost in way too many directions. They spent too much time marketing, not enough actually making new shoes. They were out of touch with who their consumer actually is. And really what really was the death knell for them was their drive into DTC. They thought, okay, we're good at selling shoes. We're going to be a retailer now. And not only are we going to be a retailer now, but we're just going to kind of stop shipping to people. At one point, Nike, in 2017, they said, we're going to go more direct to consumer. We're going to run our own stores. They ended up eliminating 50% of the storefronts that carry Nike. Now, that is a holy cow. We're going to leave the island and we're going to burn the ships as we do. We're going to go to a brand new place. We're going to burn the ships. There is no escape. Right. You can't just, leave with no alternatives. Now, normally that's going to be an incremental. Normally stealing share from any type of company is, a little bit fuzzy. When it's a company the size of Nike, as huge as they are, as dominant as they are in the global industry, a $50 billion company for, way much longer than they should be. They still think of themselves as a growth company, but that's just huge. Hoka's, it's 1/10 that. On Cloud is going to do $2 billion next year, so that's going to give them 5-6% the size of Nike. The idea that Nike's going to be spilling that kind of market share, they're going to be opening themselves up for other people to take that shelf space. That combined with the move into more athleisure, more sneaker friendly type of environment, that exploded, and Nike was absolutely wrong-footed. They weren't in the right stores. They're not that good at retail themselves. DTC, it looked like genius for about the first 3 months of COVID. But as the world started to reopen, all of a sudden Nike wasn't being carried at most of these stores anymore. The vendors were pretty ticked off about it. And oops, turns out Hoka's are awesome. On Clouds are awesome. And what you hear from Foot Locker, literally the only thing they had going for them that's really good is we're selling just a ton of full priced Hoka's and On Clouds and Skechers and all these different things. Nike's in the markdown bin all of a sudden. And all those are a huge problem. It's hard to get that back. And so the insight, the trade was simply, whatever you do with Nike, the better thing to do is to buy everyone else. Because it's right now you have Foot Locker, biggest kind of shoe retailer in the US. They're doing about $8 billion a year. That's not nothing. That used to be 70% Nike's business. Over 70% was right. Just Nike at Foot Locker. Now it's below 40, and Nike's back begging Foot Locker for shelf space. And Foot Locker's kind of, we're doing pretty well with the $180 On Clouds that we literally never have to mark down and people ask for by name. So, maybe we want you back, maybe we don't. But all we really care about are your retro Jordans, and everything else we can take or leave. And so, we heard Walmart report yesterday, and the big takeaway or the big guess was that they were taking share from Target. That is not how the math works. If you're the giant, it's really hard to take share. Nike could take 20% of Target's business. It's barely going to cover an increase in comps. It's in the case of Nike, as they spill, that fuels the gains for like 4 or 5 different shoe companies easy. Adidas has taken share from them in a way that's like 30% of their business. On Cloud has doubled their business in 2 years. I would argue most of that share came straight from Nike. And so that was kind of the insight. Let's make a blanket bet.
Is that technology? Just what was Nike doing? And I've had Hokas, and I've on now, but like I had them for years, right? And it was like, it's like Nike missed the whole idea of improving their shoe.
And they kind of missed the entire idea of, for want of a better term, and I include myself in this, not necessarily unpejorative adjective, but the dad shoe.
Yeah.
It's just that entire dad shoe. We're going away from wingtips. It's all related to what Lulu capitalized on, which was the basic insight of, all our clothes don't have to be uncomfortable. We don't need to
Right.
wear wool pants everywhere and uncomfortable leather shoes. We can actually kind of, have classy looking shoes that work for comfort. Nike missed that entirely. They were super focused on a lot of those big hot drops that they would do on pushing their app,
Right.
and just culturally they fell apart. Nike's always been a really insular company. It's I consulted with them as well. I'm not sure I didn't put them
Is
on the
that the
list, but you would
problem?
go
I
in.
mean, they also have a guy who was important. I mean, I grew up in Chicago, so but my kids really don't know Michael Jordan, right? It's like, so how my teenagers. So it's like they missed
Yeah, a
the
super
technology
surly
issue.
60-something-year-old man who golfs a lot, smokes cigars, and treats everyone like human garbage. That
Right. And
turns
if they
out not to be
Googled it, they probably
necessarily the
would just
best
see the
spokesperson.
Netflix documentary. They wouldn't know anything else about him, right?
Exactly. All they know is LeBron is better as far as they're concerned, and they don't want to hear anything about it. But that it's and they kind of got trapped in that. It's the legendary deal of all time, right? How much money Nike and Michael Jordan made off each other off those original line of shoes. But now you're in a situation where the retro Jordans are trading like crazy. They're great. They dropped the retro Jordans, and that's a great example of it. Kind of ties it all together because that was the one thing that has been working for Nike all along. Is we've got the new Air Jordans coming out. They're hot, they're necessary. Up until a couple of years ago, there would be a line for them. It was kind of that dream. They would kind of constrain production a little bit, and they could sell them for top dollar. Well, Nike used that as a way to lever their DTC business, and they would refuse to give that to any of their vendors.
And
So you
what do
can
you
create
do
a
now
little
with
too
this
much
management
scarcity.
team? What do you do? Are they going to be able to fix themselves? Do they get it, or what do you do from here?
They seem to be starting to get it. There are red flags that are a problem. They actually use the word innovation 47 times in their most recent conference call, which I used the Quarter app to count it because I was listening. I was on the road as I was listening. I was like, man, that's a
It's a
lot of use of that
buzzword.
word for a company that makes shoes.
Yeah.
You're
That
not a
hasn't been
rocket ship
innovating,
company.
right?
Right. So what you're going to do is you're going to put some things on people's feet so they can walk without suffering pain. Is that the idea? Is that the innovation you're making? Is it a new color? But that was really kind of it. It's that level of jargon's no good, and particularly when they married it with, you won't believe the innovation in the Pegasus Edition 41, which came out 40 years ago. So
Right.
we've got brand new ones. The latest Air Jordans are our most innovative yet. And it's like, you know what? Enough of just telling us you're going to innovate, and why don't you just give us a new shoe? It would have been much easier just to kind of come up with something on Cloudish, which didn't have a basketball star's name on it and were just really comfortable to wear around. And so they ironically sort of missed the retro trend that Adidas took incredible advantage of.
Right.
I was on a walk with my daughter literally yesterday that she was wearing a pair of Samas. And she's like, "Oh, I don't want to get my new shoes dirty." And I'm like, those shoes probably cost about 4 cents for someone to make, sweetheart. There's literally nothing in there that isn't patent expired and welded together. It's like these. That's this entire retro move that Adidas is making money on. Adidas made money off Yeezy. They're actually selling
Right.
Yeezys more than Nike can sell their other stuff. So it's a company that kind of lost who they were. They got tied up in advertising games. I don't really care what a company's politics are. I care if consumers are talking about them. I care if they're choosing to alienate any percentage of their customer to try to make some sort of statement.
Yeah.
Nike got way over their skis, way too involved in what people's politics are, when you really just want something that's comfortable on your foot and helps you move a little faster and a little more stable. They can fix it, but can the present CEO probably do it? I think he's smart enough to. I think it's not an intellectual horsepower. There's certainly enough smart people in the building. It's an insular culture, but they're not unsmart people, but they just have too much baggage at this point. And so that's why the stock is so much higher this week. It's not because of any of the 13F filings as much as it is just look what happened with Starbucks. Looks like, it's another place where the solutions aren't necessarily all that complicated. Nike is backtracking. They're trying to get back in with the vendors, but it's going to be really hard if you're the guy that just pulled all the inventory. Sure. And there are people at Foot Locker who are young enough, or have been there long enough rather, to remember what happened when Nike decided to yank them. And they don't need them, and they're selling absolute full margin, right, unbelievable full boat Hokas and OnClouds as fast as they can. That isn't necessarily a channel that's wide open in Nike just yet. And so it's going to take kind of new people just because they need to change the conversation on a fundamental level.
And so we think about one of the companies that did take some of the share from them, Lululemon, and as a personally, I love Lululemon, and I stopped buying Nike, so I can attest to this. But now Lululemon, since the S&P inclusion, has had a bit of a rough run as a stock and to the extent of the company. So what do you think's going on there? Are they in the same boat, or is this something different?
They won. It's which sounds glib, but it's both glib and true. They won. This is what happens in specialty when you win. They became it's culturally dominant. The idea with them, and I've been long Lululemon, or I was long for almost 10 years, simply on the idea that men like comfortable pants too. And so call me crazy, but yeah, an idea I stumbled upon, I think it was August in New York City in about 2013, when I realized the wool pants were cooking my chestnuts in a super uncomfortable way. I used to joke about the pocket rice pilaf, where you just put a little rice in your pocket, walk around the block twice, and you steam it and just kind of season to taste. So Lululemon came up with breathable fabrics, a different kind of pant for men, a different kind of look for men. No one thought that they could really do that because they were the yoga pant company. It seemed like an impossible task. Well, that's a multi-billion-dollar business for them now. The yoga tights have been incredible enough for them to get knocked off by everybody. And now, just like they did to Nike, you've got the Fioris of the world coming in, and they're taking share. It's not even a public company yet. It's up to $5-6 billion in valuation and probably half that in revenues. They're starting to take share. The competition's heating up, and the days of double-digit growth, just kind of are falling out of bed. Double-digit same-store sales for Lulu. It's really hard to overstate just how good this company was for 3 or 4 years. The heater they were on is almost impossible to replicate, and management is really smart. They're not doing a ton of terrible things. Remember when they bought the studio? I thought honestly that was going to tip them over. It seemed like the worst idea ever. Their ability, the alacrity with which they recognized that as a problem, got rid of it, and minimized the damage was super impressive. It's many companies have come before and tried to diversify and fallen apart. Nike, for instance, thinking it was a retailer. Lulu briefly thought that they were going to be gyms. They somehow got away with that, and they figured it out. But at the same time, their core product, their core innovation was aging, and so they were stuck, ironically, with kind of the product quality that makes this stuff last forever. It's incredible how long you can actually wear this, but that means you have to go to the store less and a dominant share. And so, all it took was a little bit of a misstep. The stock has been digesting gains, because they came out of the pandemic just perfect, right? Holy cow, comfort clothing, like this is just ideal because I've got 9 Zoom calls later.
It's like they hit that right. It was like everyone wanted to work, was working from home and wanted to look okay, right? But wanted to be super comfortable.
Right. Which has actually, kind of transitioned into our little hybrid lifestyle now, where people work, 3-4 days a week, but we still like to be comfortable. That's been tremendous for them, but it's again, there are just more competitors on the playing field now. And with the run they were on, with 20% comps, with 25% growth, the men's thing as that grew was just incredible. It was kind of a matter of time, but it's so profitable, it's so lucrative, and they never had to mark anything down. So the margin stayed strong. The growth was still pretty good. But really they just kind of ran out of runway essentially. And it's just hard to keep innovating. They peaked with kind of the fanny pack revolution of a couple of years ago. They sold an unbelievable amount of fanny packs, which to me are timeless, not so much to other people. But it's your second act after that. It's hard to keep your margins high. It's hard to keep kind of going that strong. And all it took was after years of digesting these gains, Calvin McDonald, a CEO who I respect a great deal, the stock was near 500 in March when on the conference call he said, you know what? U.S. sales, our comps are just about flat. We're seeing some real weakness in the U.S. consumer. The stock cratered instantaneously. Instantaneously, it became almost indefensible with the idea that, if North America goes south, it's a problem. Now you've got a China story. Now you've got a Europe story. And man, I can own a bunch of expensive stocks that have problems in China. And
so Jeff, what do you do here? Because is there anything, as you said, they won. So is it now just about valuation, where if it gets cheap enough, you'd be interested in this? Or is there anything they actually can do to not change who they are, but expand in a way to get more exciting growth? Is it just a valuation game, or is there something else?
First thing they need to do is stabilize. They're going to post a pretty bad quarter coming up here at the end of August. They had a big recall. They put a lot, another company using the word innovation way too much, but they had innovated a new fabric for tights, and they ended up having to recall it because it called to mind the sheer yoga tight fiasco of a few years ago. They took them off the shelves. They were not flattering, and there were complaints about the product quality. That's going to be more than enough to give them negative comps in the U.S. So, that makes them a falling knife. I need that to stop. I'm not sure what kind of brand damage that's done. I don't think very much, but from a stock perspective, it's still a stock that people love to hate. I mean, you would think that people would be giddy over the fact that it works so well to the upside, but it just keep coming down. People want to short that and have wanted to short it for a really long time and are kind of gleefully betting against them. And it'll be a bet that works until Lulu can prove that it's not. And they need to stabilize. If you look at kind of the great specialty stories in history, the best is the Gap. Who, if you remember swing dancing, if you remember kind of the late 90s Gap, I once saw Mickey Drexler, another guy who's just a titan, an absolute unbelievable stud. I saw him present in the late 90s, and he was talking about how Gap's next growth opportunity was to put multiple Gaps in every mall. That way customers wouldn't have to walk all the way across the mall to get to the other Gap.
Well, you got the obesity epidemic, right? But maybe not the strategy on it.
Yeah, it's like that kind of makes sense. People openly didn't laugh at him. That's how respected Mickey Drexler was. Where it's like, really, you think could you put 3 in a mall, Mickey? Sure, a big mall like Mall of America. Every other store could be a Gap. Why? I don't know how you don't see this. And then they went into the kind of huge parachute pants and the big everybody swing dance and stuff. And that was their cultural peak. That stock was 70 something at the time, up from 60 cents 15 years before that. That was one of the monster runs of all time, kind of dead money cents. And if you use that as your example, and I'm not even criticizing them because they still exist. You don't see a lot of Benetton's around anymore. You don't see a lot of these companies just disappear forever. In fact, most of it, Limited Express. I don't think they exist. I think Limited Express is in some brand, the one of the brand gulags that the PE shops make, where they just kind of buy up all the brands and churn them out. That's the normal destiny.
When I was young, I did some modeling for Benetton. They had really good sweaters in the 80s.
Sure, and they were great, and but they're gone now, and just kind of a fond memory. Gap still exists; they're still sort of relevant.
I also they just Ocean Pacific. I remember that brand too.
Ocean Pacific was a great
OP. Yeah.
Oh yeah, because who doesn't like to surf? I remember them blowing up. They were complaining about that the London stores weren't doing well, and it's like, is there a ton of surfing in London? Because that doesn't seem like a natural market fit for you guys. It's maybe I'm missing something, but you might be a little overextended. But Gap is still doing like 10 to 15 billion a year revenue. They just hired the Mattel guy. They're always kind of on the cusp of turning around. And if it triples from here, it'll be back to where it was in 1999 when Mickey was talking about putting multiple Gaps in every single mall. That's kind of how specialty is. That counts as a W for them. They still exist.
So, it's funny because I was looking at my Bloomberg as we were talking about the valuation. So you get Lululemon at a 5 to 6% free cash flow yield, depending on your number, and then 10 times EBITDA. no debt. I mean, $2 billion in cash. At what point do these guys start getting more serious about the capital structure? Like, let's pay some dividends, boys. Like, maybe take a turn of leverage. Like, your multiple, like, double-digit growth days might be behind you. Does that take a new management, or does that take an activist, or how do we get there?
It would take really good management. If Calvin comes up with that himself and manages to pull it off and manages to get people to not give up on the stock when he decides that we're going to be a dividend paying company right now, that's Hall of Fame stuff. He's already a great CEO, but that's kind of what it's going to take. More likely is that they continue to try to innovate and try to kind of come up with a next growth stylings. It's really unusual that you can see the same management team, whether it's just a matter of credibility with Wall Street or just that kind of thinking. He's been running one of the great growth stories of the last 20 years in specialty retail since 2018. It's a huge grinding, like shifting of the gears to get that company to start doing it. And also, Ben, they need to stabilize business, right? I mean, they're just coming out with sort of a flop product line. They want to make sure that they can continue to kind of solidify men's. They made pants. That's great. They're not great with men's shirts. So, it's can they split that off into a different business? There's a lot of different growth things they can try, which unfortunately most of them aren't going to pay off even under your best case scenarios as well as what they've done so far. So yeah, but that makes them a little bit more of a value trap. Someone said that they're going to get long at 10 times forward PE, which is great, but I don't trust your 10, because I'm not sure what has to go right for them. I don't think they're going to have a huge Christmas. I don't think they're going to have a huge back to school. So, what does it look like if you strip them away and you're just sort of selling your basic stuff without a good trend behind you? We talk a lot on the show about, if you don't have a great consumer, you need some sort of tailwind, like Nike dying. That was the second essence of the shoe trade. Lulu doesn't have a great consumer anymore. They don't have a huge competitor that's just barfing up share. They've got kind of a brand that's taken a couple hits, still really well regarded, still great looking balance sheet. It's cash rich, monster margins. The margins are going to go lower as they start to have to mark things down for the first time in their history. There's a lot of stuff for them to navigate before they're going to be real comfortable messing with the capital structure. But, it'll be activist bait, in a while. Right now, I'm much more interested in Nike as a stock just because you can see that potential of it's not a falling knife anymore. It's just splatted. It's everyone's now fully aware of their problems. I'm not sure why they weren't 6 months ago, but man, that Q1 that they reported convinced anyone who was doubting that Nike had problems that they do have problems. And so from here, it's much more likely to reverse than Lulu is. Now, that doesn't mean that Lulu can't bounce. Holy cow, it's down 50%
right
since the end of the last year. I mean, that's an impressive little run there in terms of a drop. Nothing goes down in a straight line forever. But, it would reverse for a trade in terms of if I want to put money away and just keep it there, that's going to be a while.
Any thoughts on the beauty space between Estee Lauder being down 75% since its recent peak, or Mr. Buffett getting involved in the Ulta?
I'm not sure what he's doing in the Ulta. Because first of all, I don't think Warren himself is making that call. But the thing with the Ulta is, I would worry just about that as a concept. Just, do we really need department stores for makeup, like as a freestanding thing? Is that something we need? Elf is a name that I've played with much more. They've been just pistol whipped the entire way down because of Estee Lauder, because of Ulta. It's actually in that same quarter that Lulu missed. Ulta was the one who destroyed the entire makeup market by blaming the consumer for that. Elf kind of came out with we really honestly don't know what they're even talking about type of quarter. Huge growth, great stuff happening. In their last quarter, they came out another, terrific numbers, and the stock looked like it was rallying at least into the number. They reported numbers that honestly, if you'd listened to Estee Lauder or Ulta, you would never expect Elf to be that good. And then they got on the call and they said, well, if there's tariffs, obviously we're going to have to raise prices. Now, if your entire thing is that you make, nice mascara that doesn't cost much and you can sell it at all kinds of different vendors, it's not great to just get into the business of idly speculating on the political impact of various tariff scenarios. I'm not sure what's going on with that story. It's not a cheap stock. But I think over the long haul, at least in terms of a speculative bet, that works for me more, even than an Estee Lauder, which looks much cheaper. But I'm not sure that that traditional model is going to exist the way that it once has.
Right.
And paradoxically, it's like if you're Elf, you're selling the cheapest products that are pretty good quality. That shouldn't be a nightmare in a recession. If you're Estee Lauder, you're a little bit more prestige, and I'm not sure that that's not a good that people can't substitute on the way down.
That's right. Yeah, and also too, like there's product at Costco and other places that I'm sure that people would rather just pick up on the cheap if they want to have something versus be going to department stores or otherwise to pay up for
Exactly, or to the alt or the special trip. It's
right.
Elf really changed the game. Now the stock reflects a ton of that, but it's in terms of being this kind of game changing innovator. It's been a while since we've seen that in makeup. Ulta had a tremendous run. Mary Dillon, ironically, and particularly in light of kind of the conversation we're having, but I think where she is now at Foot Locker has more of a chance of reversing than the makeup space does at the place she left, which is Ulta.
And, Jeff, we've talked about it. When I was a young retail analyst at Fidelity, one of the companies I covered was a Dick's Sporting Goods growth story. It was a much different sporting goods landscape back then. We had many more players, and then some of them, the Sports Authority was a big player, no longer there. Leonard Green, those guys. So tell us, a lot of retailers after COVID did well, and I personally was short Dick's, and I was fading it, if you will. But you've been pretty adamant about it, and it's been a great call. Was that because of the Nike thing that gave you that, or do you think the new management's executing, or what kind of drove you on that?
I would compare them to Best Buy. Pull up the 5-year charts of those two companies. You can overlay them, and I would encourage the folks at home to do the same. And you'll see two companies that went through kind of the early stages of COVID just in lockstep. Just, it's for two companies that aren't doing really the same things. They're just big box, kind of one special category type of products. They both, I would argue, became much better companies over the course of COVID, much more disciplined. They figured out how to be online better, much more effective. Back when you were covering Dick's, that was not only just a different sports landscape, but Dick's management was quite a bit different. They spent a weird, just huge amount of time talking about hunting rifles for reasons that are baffling. It's right. I mean, that was their thing. The guy would go on the Today Show and talk about how he was going to gradually reduce carrying hunting rifles at Dick's, and it's like, this is how you're using your time. Like it's a tiny percentage of their business, and they spent years kind of just slowly reducing, and no one really cared. That's a silly thing to be. But
so how did you make the
difference
call,
between those
how
two?
How did you know to make the call on that name? What was it?
Because what I did was I looked at it and the problem that Best Buy and where these two companies diverged. If I was really smart, I would have shorted Best Buy and just used all the money to buy Dick's instead, because you need to replace your sporting goods. Because as they came out of COVID, as people went back into the universe, all of a sudden you had Dick's position. They're the only player standing. They've got stuff like Golf Galaxy that they wrote down to nothing. Everyone's playing golf during COVID. That gives them a tailwind. Kids are going back to school. That gives them a tailwind. They're a better company than they were before under new management. Awesome. Sign me up for all that and then some. And that took a lot of the cyclicality out of their business. It lowered the competition, and it allowed them to just kind of emerge a larger market.
I'm going to interrupt you, which is the terrible thing to do. But how do you choose that versus someone, I'm going to say it, like going to Amazon, right? Let's say I'm lazy. I don't want to go to the store. I got even lazier during the pandemic. How do you decide that you want that in-person retailer making these changes, maybe having the product that I need? How do you have that foresight to say that I'm going to bet that this is going to work now?
Because I'm also a parent with super jockey kids that are probably a little older than yours. And if you're a lazy parent, which I'll cop to as well, what's a bigger pain in the ass than going to Dick's once is buying it from Amazon and then having to return it because it doesn't fit your kid's feet. Because you got to try that stuff on. You got to try the golf. It's what saved Golf Galaxy and the biggest revolution in that very, very tired industry, which we may or may not hit on more, it has been fitting, has been golf club fitting. That's like magic sauce. That actually improves your game much more than you would expect. All of a sudden, that becomes a thing where you need to be on site.
Okay.
You know, it's as these products is more specialized. If you want to try the new shoes, well, you've never had a pair of On Clouds. You're not sure how they fit. That gets you into the store. And as it turns out, Nike just kind of shivved dips just like they did everyone else. And they're carrying kind of fewer goods and they're not dropping the hottest brand. So, you know, that brings people into the store. And there's some stuff that you just need to try on, no matter what you're buying. A real part of the core business there, once you get past Ed Stack and his hunting rifles, is going to be stuff like hockey sticks for, you know, football equipment for the new kid. And kids have a tendency to grow. They tend to get big. You want new running shoes, you got to, you know, these are things that are kind of best left tried on. And so that got people into the store, as opposed to just the monster markdowns that you see. No one needs a new TV. We just moved, as you said. You know, there's been no innovations in that space at all. My TV's as nice as I need it to be, unless I develop better vision, which seems unlikely at my advanced age. And
although they have those cool TVs that morph into art and stuff, but they're just too expensive. I'm not going to go there.
And they're just kind of silly, right? That's where we are at the innovation stage. I mean, we've gone from going from cathode rays. I mean, remember like the sunken boxes you would have and the 20-pound TV, just enormous TV. Like, you know, a flat screen's a flat screen, and you can kind of tell the difference, but you don't need one in your office necessarily. So there's no compelling reason. And on top of which, during COVID, I still don't know exactly how this happened, but apparently, like, the television industry made 1 billion televisions. Because remember how long they were marked down? I mean, you could get like 2 TVs for $1,000 bucks.
Right?
Yeah, it's crazy.
Right? Everyone's buying, like, going crazy in the pandemic, buying everything.
Right. And no one needs to upgrade anything. That's no different than the rest of the home furnishings. You know, that's just been a disaster business. That's been yet another entire industry where people point to it and they say, look, we're in recession because nobody's buying home furnishings. You know, kind of, but you can meet that thesis halfway by saying, yeah, well, they bought a bunch of couches during COVID. It wasn't that long ago. And how many times do you need to buy a new TV, a new couch? I just moved the old ones that I had straight over to this house. I don't need it.
Right.
You know, that business is just kind of tired and dead.
And you were talking about golf there. So can we get back there now and say, like, what, you know, what have you been seeing? And then is this interesting from any perspective going forward?
Ben and I have been shooting emails and texts. And we kind of, the Callaway Golf, which is now, they changed their ticker just because the ticker Eli was way too awesome. And so they became Modern Golf Concepts and bought Top Golf. Because just the way Nike thought they could be retailers, they thought, boy, we make golf equipment, so we might as well make driving ranges. Not just driving ranges, but driving ranges that have a footprint the size of a football field. And, you know, they are the most expensive ball retrieval on earth. And so now it's 2 companies, but it's also a cool core business that's suffering. Dave and Buster's is another game that you play with. These companies where they run a business where it requires people to hang out. They all kind of spiked as we came out of COVID, and they're all suffering. So Callaway, whatever they call themselves now, Modern Golf Concepts, they just reported a quarter where Topgolf is down 8%. They blamed the idea that there are fewer corporate events coming out of COVID, which just seems crazy to be saying in 2024. I mean, that's one area where, you know, it should have stabilized a little bit by now. They don't do anything particularly well. They actually warned in Q1 because of a European clothing division that they have. That honestly, it's like, what the sweet, you know. Yeah.
So
the English outerwear division. That's totally something I was looking. It's the most obvious breakup in the history of the world. It's just whether or not it's kind of worth going after and chopping it up, and you have to be the activist yourself. But I mean, I can think of a half a dozen ways to fix it. They're selling driving ranges and they're run by Callaway, and they don't really sell golf clubs, which is just holy crap, you guys. Like you know, it's funny, you hand people Callaway 8-irons and sell a few of those. Because it turns out you have these driving ranges and that you're just going to keep building. They've got negative comps for the last several quarters. They're guiding lower, and yet they still are planning to expand as fast as they can. I mean, it's nothing but low-hanging fruit. You just get them to go in there and stop hurting themselves. That's going to be worth at least something. You figure out how much the European outerwear business is priced at and you sell it for next to nothing. I mean, you can chop it up and it's the fees almost kind of just, it pays for itself. They can go into business with Dick's and say, how would you like to fit golf clubs here at our driving ranges that no one wants to hang out at anymore? You know, there's a lot of different ways to kind of break this company up, to chop it up and make it work. Golf isn't going anywhere. Is it going to get more popular? Nope. It's going to be levered kind of basically to rich, lazy people's GDP forever. But, you know, it is still a thing. It's got, you know, more longer legs than, say, bowling, you know, or a lot of different other sort of fatty sports. We've dedicated a lot of resources to it, but it's just going to be boring. They'd be much better off private and probably 6 or 7 different companies than they are in this little baby conglomerate that is just way too heavily in debt. The question is, again, if you can stop the bleeding, you know, step one would be just please stop building Topgolfs. They seem to think that there can be 200 of them in the country. I don't know if you guys have been to one. There's not going to be 200 of them in the country. I mean, it's a mildly enjoyable experience, but it's a driving range. So, you know, there are cheaper places to go smack golf balls around.
And really expensive. I mean, the per unit builds on those are really crazy. I mean, look, the other thing is Callaway, they live right north of you, up in Carlsbad. And I used to, when I had owned 15% of the company, I was at Fidelity back in the day. And I remember going to Analyst Day, Phil Mickelson come out. And those boys are playing golf at like 2 o'clock in the afternoon. So, you know, maybe it's just a management thing there, right?
It could be just a cultural thing. Exactly. It's really easy to speculate because the decision making is such that it's the kind of decision you make after you've had a couple pops and you've been on the golf course since noon. It's like, you know, we should buy an outerwear company is what we should do. Have you guys ever thought about British raincoats? We could get British raincoats. It's just like the clubs, only it's a raincoat in England, and it will be diversified. Yes, you know, I mean, just sell the balls, guys. You're going to be fine. I mean, the PGA is not going to get worse. Professional golf is not going to become a worse product. Like, you know, Phil Mickelson's a local guy. Plenty of stories about Phil now that you didn't used to hear. You know, it's golf has done its best to shoot itself in the foot, and you still have kind of an okay business with these clubs. They've got really leading market share in clubs. They're pretty close in balls. You can chop up and sell it to a bunch of different conglomerates that own kind of the top flights of the world. It seems like it would be a supernatural fit. Again, you have these huge locations that you're not selling clubs at, which honestly to me is the head thunker of all time. I mean, I just want to smash myself with a putter every time I see that because, you know, these are enormous parking lot sized stores that are located kind of in the outskirts of town where you normally would find a Walmart. The idea of doing retail there makes almost too much sense for it not to happen unless you're just playing golf all day and not taking Dick's Sporting Goods call.
And so, Macke, you have a really good eye, obviously, for picking out trends before other people realize that they're trends. And so is there anything that you're seeing now, whether it's for younger generations, you know, how people live or work or play, that you could say, oh, there's trends that I'm watching, or things that I'm watching to see, is this something new or something to get behind?
You know, I'm always looking for just kind of your latest fad. Right now, we're still working on the old trends. Right now, you know, the omni-channel thing got really perverted as we went into COVID and it got accelerated. I've been playing that for years just on the idea that you're going to get to about 25-30% of just online shopping for reasons you already touched on. It's simply a much more convenient way to go ahead and shop. That became warped as we went along. But some of the opportunities that I'm finding, if I can find good management, I'll give you one company, Aritzia, Canadian company, you know, $5 billion. It's pretty small. They're only doing about 57%, give or take, of their business in the U.S. so far. They have a very specific customer. You know, it's kind of, they're the workplace company that Gap should be. Banana Republic should be selling women's clothes the way Aritzia does, which are private label, really classy stuff that is not that overpriced that women can wear to work. That's a terrific business.
Is it cheaper or more expensive than a Banana Republic?
It's a little bit pricier, but they earned it. Banana Republic, you know, could Banana Republic price better if they didn't do things like just make only skinny pants for 10 years at a time, which are just crazy. And it's, you know, I'm not sure, but it's not so overpriced. My daughter was the one who turned me on to them. I started looking into the company. They're just coming in to America. They've got a few different trends I like. I love that they brought in a new CEO who replaced the founder. She took a couple quarters to get her stride. You can see that in the stock. She wasn't communicating it very well. She's gotten incredibly better. I have a lot of respect for Jennifer Wong. I think she's doing a great job. They can grow in the U.S., which is obviously a bigger market than Canada, and they don't have anything really online yet. And so it's almost had this kind of startup ethos where it's something like 28% of their business is online. That in the States, Lulu, for instance, is closer to 50. You're closer to kind of a 40-60 type of online, offline. But what they can see, the reason I like that with the potential U.S. expansion is one thing that we've seen consistently is if you do both, it works better. For instance, you go into a new market and you're online already, it's going to help your store. It doesn't hurt it. You're not cannibalizing your sales. You're actually enhancing your sales if you're easily, readily available both in the app, online, and at the mall. People like that more. They can return it better. It develops much more loyalty in the customer. I love stories like that. I love that slow developing one because it's less of a huge risk. It's less of, you're not rolling the dice on whether or not people are going to wear men's clothes from Lululemon. You're just rolling the dice on whether or not these people seem smart enough to execute the opportunity in front of them. Now, we're not in the sweet spot of that mall space for a while. Aritzia rather was able to get really premium mall space. But what they still are making great boutiques, really terrific, attractive stores that are unusually nice, and they're great for the mall guys who are still trying to develop traffic, still try to get that consistent flow that they saw pre-COVID. And so this is the kind of store that they really want in their chains. They're developing flagships in Chicago, New York. So they're building out smart, they're building out patiently, and it's the kind of company that I've been buying dips on, and I really like them. And so it's less brand new trends than kind of let's take a look at some of these existing trends, and we can sit around and work on the hypotheticals like Callaway should be broken up, it could be broken up. There's a million ways that you can kind of think of ways to play with it, but you need a few names in your portfolio that are just kind of, if these people execute, it's going to work out for me. Like this name, Aritzia will be all over the place. It's a freaking Toronto. It trades on the Toronto Exchange, which is like three guys in snowmobiles that trade stocks twice a week or something. But it's not without its warts. But there's a lot of upside there. Smart companies going to continue to execute, and I like that. I like just people who can execute. There are plenty of disasters out there right now. Let's just give me a company that has a trend. You know what people like? They like nice clothes at reasonable prices in a store that I want to hang out at. So that works for me, to name one. It's and just kind of stuff like that's where I like to live. Yes, Ben.
Yeah, I was just going to say that it's interesting because we've talked about the consumer became so winners, losers, and the winners just, maybe that's how the whole economy is, right? Costco is trading at a bigger multiple than all the Mag 7 now, right? And great company, great culture. They do everything right. The hot dogs stay at $1.50 no matter what. And then, Deckers and some of these guys. And then the other ones, is there a convergence trade there? Or do you see it, winners keep winning, losers kind of maybe have some false starts, and maybe one or two of them return?
We started with Target, and we're kind of going to wind up kind of in that vicinity as well, because it's unfortunately, them versus Costco is a nice cautionary tale. Those membership fees that Costco's gathering, that's why it has the multiple, because they can just basically treat retail like, let's break even, and we're going to make billions of dollars selling people memberships at our club. And they also have the advantage of, if you're checking in members, they don't shoplift as much. And so, that's a genuine, real problem for Target. I'm not sure exactly why, and I don't want to get all that political, but that the theft thing has been a huge problem for Target, and it's really hard to see how you make a store that is predicated on the idea we're going to be open, friendly, we're going to kind of welcome all our customers, but we have to lock up all our product because people steal us blind. I was at Target yesterday. It takes you 20 minutes to pick up a simple item because you got to find some guy to unlock the batteries. Yeah. And, you just stand there and I cry a little, and I wish my dad was there to beat the snot out of somebody, because they don't care if my bald ass is ranting, but boy, they respected him when he was running the place. But that's that. And so there would be a convergence trade, but I'm not sure how we can fix it. Another problem that Best Buy, we talked about them with Dick's before, the theft is a huge problem there as well. Those are two, not coincidentally at all, Minnesota companies where they were really victimized. They had huge shrink numbers. Everyone kept telling them it's fake. But I can tell you right now, no one at Target wanted to lock up the Vicks Vapor Rub. Nobody was dying to oh, this will be a much more convenient way to sell our products. We'll put it all under lock and key and just make the place look like some aquarium where you got to find somebody to let you
like
pet
Walgreens.
the fish or the dog. Yeah, same thing with Walgreens. Ben and I were talking about that, where it's like, talk about a name you don't like. Ben spat out Walgreens. We weren't even on a Zoom call, and I actually cringed. I was making social facial expressions of disapproval just as I read it. I'm like, oh God, what? And you kind of want to buy it, but then you go in the store and it's like, I don't know how they fix that. It's really hard.
Ben,
and
like,
again,
the pharmacy at Walmart is better run than CVS and Walgreens.
They've got a nice, a bigger buffer. They can afford to run it. It's all that stuff that was just kind of garbage retail in front of the Walgreens, designed largely to treat the impulse shoppers who are picking up a script, right? We got customers that are going to have to kill time at the pharmacy for 10 minutes. And so why don't we sell them, here's a map, here's a coloring book to quiet your kid down, whatever. It wasn't a truly inspired retail, but at least you didn't have to lock it up. Now, if you sell cold goods, they're just not in stock. I mean, Target is just carrying much less inventory. They're way too lean. And you got to be super good at merchandising to carry 60% of the inventory you did before and still satisfy customers. And that's not
Jeff,
something they've solved yet.
I know you need to get on that golf course. So
exactly. I am going to play golf because it's market research.
Hours with you. So I want to make sure you get your tea time there because we can get in the weeds of retail and consumer stock. So we just want to say thank you so much for sharing all your wisdom and experience with us today. And please let our listeners know, where can they find you if they want to connect with you or hear more about your thoughts?
You know where they can find me. They can find us in multiple days a week, every morning. It's Wall Street Beach, baby. Let's go. No, it's been my pleasure. And you can hear, Ben and I talking consumer. You can hear Nadine skeptically kind of questioning why anyone would go to a store at all because it's so much easier to shop from home. I love all of it. We're doing that 5 days a week. So come on in. Questions are welcome as always.
Well, thank you so much.